reorganization means you're reorganizing in a way that you can take full advantage of that. So when we build assets, we make money, we keep the money, we build assets, and then we need to transfer those assets to our next generation. That is what we're talking about here. So we want to leverage the tax code. We want to leverage, we want to be smart. What is it? Smart. If you ask the top 1%, they will tell you that they are smart. That's why they're not paying taxes. This is one of the most important, the most effective tax strategies that I'm giving out there. So let's go. Oh, jeez. Okay. So think about it. I'm going to say, what does the IRS say about these things? Because we always want to go back to the rule book and see what the IRS is saying. The IRS tells you that payments for child services are subject to income tax withholding, regardless of age. It means that you are going to withhold income tax, you're going to withhold FICA, Medicare, regardless of age. However, it goes further to tell you that if the child is under the age of 18 and working for a parent, in some cases, it also says that not only does it say parent, it also says legal custodian. If that person is working for a parent or a legal custodian in a trade or business, payments are generally not subject to Social Security and Medicare taxes. So you can pay them without paying FICA, Medicare. That's 15.3%. Then it tells you that, and if the child is under the age of 21, those payments are not subject to FUTA. FUTA is what? It's unemployment taxes. The basis is $7,000 and it's 6.5% around there, 6.0%. Now, it says, however, if the business is structured as a corporation, an estate, or a partnership, where only one of the parents is a partner, then you must withhold all these taxes from the child's wages. Now, it tells you that even though it has said all those things, you have to be careful with the way your business is structured, because the structure if you are not structured correctly, then you are going to face certain things. That's why we have adopted something called family management companies. Family management company will be the way for you, the structure to be able to pay these kids. The kid works for you. How do you pay them? If you pay them using any of these structures, either a corporation, means an S corp, a C corp, an estate, or a partnership, you may be liable to pay all withholding taxes. That's not what you want. That's why we've talked about family management companies. We use family management companies to make sure that these people are paid. Now, the question is, let's look at some of the implications here. The first thing is that you don't want to, most people just think that when we talk about paying children, paying your kids is just to allocate a certain amount of money to pay those children. No, it is not. Nada. Be careful. When you are paying your kids, what you basically are doing, is that those children must actually do the work. They must do work for you. You have to pay them because they did work. And in most cases, 90% of the time, when we are sole proprietors, when we are small businesses, our children are constantly working for us. They are constantly doing that thing. Please take me that piece of paper. Please do that, print that thing for me. Please do this for me. But people, we are not formalizing it. And guess what? If you are not formalizing this work that you're getting your kids to do for you, if you are not formalizing all these things that you're asking these kids to do for you, then what happens? The next thing is you are always, remember, I tell you, whenever you are in business, you have a silent partner in the business. And that partner is called the IRS. That partner is called your Department of Revenue if you're in a state where you have to pay taxes. So the Department of Revenue is your silent partner, and then the IRS is your silent. So everything you're doing for that business, make sure they are included, they are taking their fair share of it. So basically here, make sure the child is working and formalize it. Formalize it by making sure that you are paying that child for the work that they are doing. Now, you might want to think, what is a reasonable wage for paying that child? But before we talk about that, let's talk about age. You can make your child work for you at any age. Remember, number one, they have to do the actual work. Number two, the age can be any age. Any age, meaning that we have seen children who are maybe stylish. They are at the age of 2, they're already doing modeling for their parents. Their parents, maybe they own, they are designers, they are stylists, they are designers, and the children are already wearing baby dresses and then parading and doing marketing for those kids. That is work. The IRS, so the code doesn't talk about any limitation of age, but the courts have held that 7, the age of 7 is kind of an acceptable age. Can I have everybody muted, please? Can I have mute? Please, can we all mute, please?
The last one he said that is do it.
Please mute everybody. Thank you, I appreciate that. Yeah, so the age of a child can be any age depending on the work. But the courts have held that the age of 7 is the most appropriate. So basically, if your child is 7 or above, then we think that the child can provide reasonable service to the business. Now, what do you think when you talk about reasonable service? What is that service? The IRS, according to Code Section 162A, it tells you that for anything, for any cost, for any amount to be deductible on your tax return, it has to meet 3 criteria. Code Section 162A. The first criteria is that the whatever is being deductible has to be something that is ordinary. Ordinary meaning that it is the same as any other business that is in that line of business. They will face the same kind of expense. So ordinary, necessary, meaning it is necessary in the production of work. And the third is that it has to be reasonable for the pursuit of income. So you don't just decide that, okay, I'm going to pay my kid $100 an hour. No, that amount that you're paying your kid must be reasonable for the type of work that child is doing. So that is very important. So it has to be ordinary, necessary. And this concept of ordinary and necessary is not determined by anybody but yourself, because you know your business better. Again, when I say it's not determined by anybody but yourself, the IRS says that, but you don't want to just decide anything. You want to make sure that any reasonable person will get to that same conclusion. So it has to be ordinary, necessary, and reasonable in the pursuit of income. So now, if you meet Code Section 162A, then you can deduct whatever amount you are paying to that child. Now, there is something called, this is very important, and this is applicable to your kids, to your grandkids, and it's also applicable to your legal custodians. If you have children that you've adopted or any child who's your legal custodian, you can apply to it. It's applicable to your grandkids. If you are taking any child who is underage and you're employing in your business, there's illegality attached to it. It's illegal. The only time is if that is your kid or that's your legal custodian. So be very careful about that. It could be your grandkid as well. Now, the key things here is, what kind of work are these children going to be providing to you? And before we even get there, I'm going to tell you something. One of the things that people face is, how much can I pay my kid? How much should I even pay this kid? So how much do I pay this kid is a very big one. Again, we just talked to you about Code Section 162A. The type of things, I'll give you a list of the things that children, what type of work, when we say here, what type of work, what is a child doing in your business? That child may be doing your cleaning. In my office here, I bring my children all the time to come and clean my office. I don't need to get somebody to be cleaning my office. So my children clean my office. My children are working for me. They're doing, they're doing things like, shredding of paper. They are doing marketing for me. They are online doing marketing for me. They do posting of certain things on the website. One of my children is a designer. She designs my website and makes certain things, and then support whatever team I have as a marketing team. So all these things are things that your children can do for you. Those of you who are in real estate, you get your children to work on the properties, to go and clean the properties, to do all this. All this is work. You have to quantify that work. Quantify that work. It's so important because you have to be able at every point in time to demonstrate to the IRS, show them that I did not just pay this child because I wanted to transfer money. I paid this child for doing this work. They completed this task and they completed it during this amount of time. So documentation is key. You want to always document what work. We've talked about the work. And how do you pay them? You don't pay your children. When children meet this criteria, you're not going to put them on payroll. If you put them on payroll, you're paying Social Security, you're paying certain types of taxes that you are not supposed to be paying. So basically, you don't want to put them on payroll. You put them, the system we use something called a family management company. And whatever you pay them, you just cut them a check. You cut them a check. It's called outside labor. So we can talk about that in more detail. And one other thing that I did not emphasize here is how to pay. How do you pay your child? You just cut them a check. You pay it. You want to make sure that it is going to a bank account of their own. You don't want to, if you give them cash, it is difficult for you to really justify that I gave them cash. The reason I say you should put them you should pay in a bank account of their own is because at the end of the day, there are strategies that we want to take further. It's not only about paying them. Once you pay them, then what next? That what next is what is the most important. That's why you want to have it in a bank account. Once the child is paid into a bank account, you can pay a check, you can pay into their bank account. You don't have to give them a 1099. You don't have to. You don't have to give them a W-2. No, you don't. It is outside labor and it's paid through a family management company. One thing that I have not touched is how do I determine how to pay my kid? You can't just sit here and say that my kid, we pay them $100 an hour for cleaning the office. No, it has to be ordinary, reasonable, and it has to be necessary in the pursuit of income. So what does that mean? There is something in the tax code called the standard deduction. So the standard deduction is a number that if you were to earn ordinary income equal to or below that number, you don't pay no tax. Very important. The standard deduction is that number that is provided you. If you earn that income or less, you are not required even to file a tax return. And in 2023, I'm going to take 2023. We have a number for 2024. I think it's a little bit higher. 2023, that number was $13,950. $13,950. It means that if you earn $13,950, you don't pay federal income taxes. Mind you, you may be liable for state taxes. So you want to check in your state to make sure that the standard deduction in your state is not lower than that number. So in every state, you want to make sure that the Department of Revenue setting of standard deduction is not lower than $13,900. I mean, depending, every year has a number. That number keeps growing. This year it's more than $14,000 because it grows by inflation every year. So basically, if you are paying anybody, including your kids, anything less than that standard deduction, those kids don't even need to file any tax return. That is free money. It is considered already taxed. So basically, it's after-tax money. So what does that mean? That means that if you have, say, 4 kids, like me, if you had 4 kids who are all over 7, and they are all working for you, or even if the child was, over 7 is the age that has been determined by the courts as being a reasonable age for a child providing services. You can have a child who's providing who is younger than that, but you have to be clear. It has to be clear and evident to everyone that this child is doing something that is specific. But if a child is less than 7, it may be hard for you to tell the IRS that that child is the one who's cleaning my office. That child is the one who is doing my marketing. It's maybe hard. But there are certain professions, there are certain things that a child can do for you that you can actually show them. So if you take 13,950 as your basis, and then you want to pay that child 13,950 because you don't want that child to pay any taxes. You don't want them to be involved in any taxes. You can take that number. You divide by the number of hours. I mean, you can break that number down. If you broke that number down, then you may be able to determine how much you're paying. You can easily be able to substantiate to the IRS that I was paying anything between $10 to $18 per hour for doing those type of work. The IRS requires one thing all the time. It's called comps. Comps means you have to show them the documentation, and you want to show them comparatives. So basically, what's a comparative? A comparative means that you are able to show that what you are paying is comparative to the market. That's basically it. So if you say, okay, I was paying my child $13 an hour for doing cleaning, that makes sense. But if you tell somebody I was paying that child $40 an hour for doing cleaning, that may be questionable. So that's something you want to think about. So if you pay the child less than 13,950 for 2023, then all of that money is tax free. It is tax deductible for you. Let's say you had it for 4 kids. You take that number, 13,000, let's say 14,000, you multiply it by 4 kids. That's about 28 times 2. That's around $56,000 that you're giving out for free. That is reducing from your taxable income. So if you are somebody who is seated on the 30%, or if you are seated, let's say, on the 32% or 37% tax bracket, and then you just paid your children $64,000, you multiplied by 0.3%. Let's say you were 30%. You just saved yourself $16,800 in taxes by doing that. That simple strategy saves you $13,800 in taxes. That's number one. Number two, you can also, depending on the ages of these children, you can make them even work more for you and earn even more. If I am in the 38%, 36%, 37% tax bracket, I'm looking for lower tax brackets to push the money down. I'm looking for lower tax brackets to push the money down. So my children who are working for me, if I were to pay them, or maybe a member of my family who's working for me who's in the lower tax bracket, if I were to push some of the money, I say I pay them $70,000 a year. The first $13,950 is going to be tax-free, but the remaining one is maybe going to take him into the 10% tax bracket. So instead of me paying 37% on that money, somebody is now paying 10%. Maybe my child is now paying 10% on that money. That's still money that I have. That's what we call income shifting. You can do that. Another thing that's also important is basically, once you determine whatever they have to pay, you want to make sure it's paid in a proper bank account for this kid. Why? Because it's going to help us do those things that we want to do next. It is important. All these things we just talked about is about you have now made the money. Remember, you just took $58,000 for 4 kids, $56,000, and then you transferred it to your kids. Now, those kids are not paying any taxes on that money, and you are able to deduct that money from your income. So once you do that, what next? Most of us, these are things that we do for our kids anyway. So the first thing is that this is a huge deduction for you. It's a huge deduction. Let me see my camera. So this is a huge deduction for you. Deduction because you just pushed down a huge part of your income, which was you just saved yourself $16,800 in what we just talked about. And then the second thing is now that child receives that money, and that money is tax-free to the child. So basically, what does that mean? It means that what we have been doing we have a business, and remember, this is all for business. If you don't own a business, you cannot do this. You cannot do it out of your W-2 income. You do it out of business income. It is a business income. Okay. So basically, another thing I was going to say is, if you have already, there are things that we already do. You are the one buying school equipment for your kids. You are the one making sure that they're having their transportation money wherever they want to go. You're giving them pocket money. You're already doing all of those things now. You're buying them. You're making sure that their clothing, you're the one taking care of their clothing. You just directed that money to them. And now you can take money from there to pay their school fees. You can take money from there to do whatever you are supposed to do anyway. How now the IRS is basically helping you grow your kids for you. And that is all tax-free. That is all tax-free. That is so important. The next thing that happens, this is, I told you that it's tax-free up to standard deduction. I told you standard deduction being that number that we talked about is $13,950 in 2023. And then another thing is that you can shift income. I just told you about shifting income. That's one of the strategies, but it has to be based on actual work done. I can't emphasize that enough. It has to be based on actual work done. The IRS will want to know, what did that child do? You have to have documentation to prove what the child did. Okay, now invest the money. You have to invest the money. Now you've taken, the child has the money sitting in the bank account. You have the money, the child has the money. You're investing the money already. You're using the money to take care of those things that you were going to take care of anyway. The child is now having the money you're taking care of the child through his own bank account. You don't have to take money from your own bank account and do the same things that you will not do anyway. So I hope this is making sense. Are we together? I just want you to click something in the chat. Let me know that you guys are there and it's work and this is making sense. I know this is a huge tax strategy that we use all the time, and I'm just giving it I want to make sure that we are all taking advantage of our own American dream. Now, one big thing that's going to come, once you've done all of these things, what next? What next? And this is where you start thinking about how you want to make this child, how you want to take that money and then make it grow. You want to make that money grow. Remember, we just had that money. It's been paid to the child. We've taken advantage of it. We've not paid taxes. We just saved ourselves $60,800 just by transferring the same money that we were going to pay taxes on anyway. We just saved ourselves that money. Okay, now it's in the account of the child. We're using it to take care of the child. We're using it to do certain things that we're going to do anyway. But the key other thing is that you can now invest this money. You can invest the money. There's something called high yield savings accounts. You can go and put it in a savings account, take that money and put it in a savings account that's paying some interest on this child. Now you're already saving money and putting money in an account for those kids, for those kids. So basically, those kids with the same money, the same things that you were doing anyway before, and it wasn't saving you any taxes, it wasn't doing anything, it was just expenses. I use this money to buy my daughter's car. We're buying a car based on this money. And it's coming from her. It's money that she worked for. She worked for it through the company. I would have bought the car anyway. But she's now buying a car out of the money that she worked for. It's coming out of her bank account. She cannot buy her own car. The second thing, and this tax-free money. High yield savings accounts. The other one, you can take money from there and put it in your 529. You can in your 529 account. And it's going to grow and save money for the child's education. So the same money that you were going to be doing, you're now using after-tax money and putting money for the child. This is crazy. But more importantly, there is something called Roth IRA. It is called Custodial Roth IRA for minors. You put money in a Roth IRA. As of 2023, you can put up to $6,500 in a Roth IRA for your kid. It's called Custodial Roth. And that is why you want to make the money go through the child's bank account. You want to make sure that that money is based on actual work done. You want to make sure that you've done it properly and it's passing through the normal channels, family management company and stuff. Because if you don't do it right, it might all fall crash on you. It might all crash on you. So basically, now that you have this money properly structured, you want to put in a Roth IRA. The Roth IRA says that if you put in that money, this is Roth IRA is saving for retirement. You can only have access to the money that's in a Roth IRA after you get to 59 and a half years as of today. You can only, when the child gets to 59 and a half years, then now they have access to that money. What does this mean? It means that today, they're saying that you can put $6,500 inside. So basically, in that $13,950 that you just paid the child, you remove $6,500 inside and create a custodial Roth account for that child in it. And I was just playing and looking at a website to see what is the average S&P 500 growth rate over the last 30 years. And it showed me 10.5%. That was, I thought that was really a huge number, but 10.5%, if you take that number, if you just Google, you'll see that number come up, that the average growth rate was about 10.5%. That 10.5%, if you are investing in a Roth IRA and it's growing 10.5% over the last 10 years, it means that just that one time that you put that money there could raise that child almost $1 million. That one time, by the time the child is retired. Again, I've not done the math to get the number, but that's a number that comes up all the time, that it's about $1 million. But think about it. Think about you not doing that just once. The child is today, let's say your child is 10, and you do that until the child gets to 18, and you're able to put that money in the account for that number of years. You just created millions and millions of dollars for that child when that child gets to that 59 and a half years old. So you've created a retirement account for that child. Remember, every other retirement money that you put, maybe in a traditional IRA, maybe in your 401k, all those monies that you put, that you contribute in there, they are going to be taxable at retirement. So when you're taking that money out at retirement, your 401k money is going to be taxable. But we just put that money in an after-tax savings account, in an after-tax retirement account called the Roth. So once you put that money in the Roth, you put it for 1, 2, 3, 4, 5 years, and then that child starts working. Even if the child became that type of child who doesn't take care of things, by the time that child retires, the retirement is already guaranteed by the parents, by you. Because that child will retire and have a couple of $1 million in the bank account that was created just by you doing this simple strategy. And what happens? That child is also getting this money tax-free. So maybe you don't get it. That money is tax-free. If you get $1 million upon retirement from your 401k, that $1 million, assume you're taking it, that $1 million is going to be taxed at, depending on how you take it, depending on what the tax rates will be at the time, it's going to be taxed heavily. But this is money that's going to be tax-free. So that is really what I call your building generational wealth for your kids, your grandkids, and that money is considered tax-free. That is, I mean, how else can you beat that? You can, again, and if you are that type of person who is smart, you can self-direct that money. Self-directing that money means that you have put money in that Roth IRA. You've self-directed. It means that you are putting in a bucket where it's not growing by Wall Street standards, not growing by the growth of S&P 500 and things like that. Maybe you're putting it into some real estate activity. You are going to multiply that money crazy. Remember, your biggest thing is about building assets. If you don't have assets, you don't have wealth. Wealth is not the income you make. Income, most people mistake income. You could make $1 million and be a broke man. and the other guy is making $100,000 or $50,000 a year and is very wealthy. That's very important. Wealth is about assets that are able to generate money. Let me give you something. Elon Musk, for all the years that he was working, that he created Tesla, he wasn't taking any money out of Tesla. He was building all his equity in Tesla, his shares in Tesla. He bought those shares when they were selling those shares. When he got them, they were about $6 or how many dollars a share that they were getting those shares. In 2021, those shares had grown to multi thousands of dollars, and he exercised those shares. He was not taking any money. His income was coming through short stock options. So basically, he's building assets, and he was living on debt. Again, that's the game. That is the American dream. You live on debt. Your income is coming in the form of assets. Or when you make income, you convert it to assets. And then those assets give you access to other people's money, which is called debt. Then you can leverage those assets to buy. I mean, let me just give you an example. He leveraged his asset to buy Twitter for $55 billion. Leveraging asset, he didn't pay anything. So basically, I am telling you that there is wealth. If you self-direct your IRA and then you maybe put it in real estate, that millions of dollars we're talking about is going to be multi amounts by the time that child gets to retirement. So I thought that this was a very important lesson that we talk about it today. And I have come to the end of my presentation for today. So if you have any questions, again, my name is Charles Njoya. I'm a CPA. If you're here and you're not following me on our channel, follow us on Facebook, follow us on Instagram, follow us on YouTube. We are doing a lot to help the community. We're trying to save. Every time we talk about this, we give you strategies that you can do to get into your American dream. Remember, I tell people all the time that if we do some of these things that I talk about, then it is very easily within the next 5 to 10 years, all of us that have come here and are working so hard, we will all be in the top 1%. We will all be in the top 1%. So thank you so much. Again, scan the QR code here and it will take you directly to my website. You can book a consultation with us. You can go there and book a free discovery call, and I can have an hour with you and we'll talk about your situation. Or maybe you're struggling with taxes and you want to reduce your tax bill. We are able to help you with that. Follow us on Facebook, Instagram, like our page as well, because that's the way you make more people get to follow us and see what we're doing. Thank you so much for being here. And if this added value to you, I just want everybody to go into this. Send me a thumbs up. I want to go to the chat and give us a thumbs up. Give us a thumbs up if this made sense to you or if you understood anything. I am now at the level where I am listening to your questions. If you have any questions, we have 5 minutes for questions.
Hello, Charles. This is Stephanie, and I have a question actually. And
yes, who am I speaking with?
Stephanie, and I'm not on video. I'm driving and following at the same time. So, yes. First of all, thank you for your presentation and for the information that you have shared. And I have 2 questions actually. First of all, in terms of kids' employment, does it matter? Let's assume, for example, that we cut the checks for each kid. Does it still matter that each of the kids has a separate bank account, or can they have joint account? Let's say I have 3 kids. Can I have a joint account for the 3 kids, but cut the check for each of them and for them to catch in the same bank account? That's my first question. And the second question would be to know, does making these child working work, will it make sense for a business that is at the startup phase? Let's assume I'm launching a business. I don't know yet how the year will be, if I will actually make some income. Will it make sense to actually put this into place? Thank you.
Excellent questions, great questions. And I'm going to start, let me give you your answers. And thank you so much for supporting this program and for being here. First of all, having a single bank account for all the kids, I don't know how that works, but the reality here is you want to think about, it's not only about paying those kids, right? You're paying those kids. If you pay the kids in one bank account, I think it will work. It will work if it's all in that one bank account. Again, I have not seen a situation where that causes a problem. But the reality, the thing I'm thinking about here is, what is the next step you want to do? When you go to open these accounts I just talked to you, to invest that money, it is per individual. It is per child. The financial advisor who is opening maybe the Roth IRA for you will need to see proof of that money coming through the bank account of the kid. And you want to show that, because if you don't make that trail coming through, the IRS might come and say that, oh, maybe they might, even if they might deny that that money was not the after-tax money. You want to make sure that there's trace of that money being paid through the FMC. It comes through the bank account of that kid. And then when you go to open any of these accounts, you want to see that it's coming from that person's bank account, because you're creating that account in that person's name. You're creating that account in that person's name. And that's why you want to make sure that that person has a bank account to that person. So basically, I have seen some cases where people have their bank accounts and then they create separate accounts for those kids, and then they can use those accounts. I don't know how that works very well, but my thing has always been, create a separate bank account for those kids. Let them have their own separate bank account. That is me. Now, I don't want to tell you that will work for you to have all of them in the same bank account, and then when you go to implement it, there's an issue there. But what I know is that what I tell my clients is always have a separate bank account for each of those kids. Does that make sense? Are you there?
Yes, it does. I had mute myself.
That's number one.
Thank you.
Number two is business startup. It depends on what business you're doing. You're starting a business. There are businesses out there that you start, and then you could spend 5 years. It's all accumulation. It's all expense accumulation. You're accumulating expenses. First of all, you want to make it to be reasonable. When I say reasonable, everything has to be reasonable. You don't want to create an account just create a business just for it to be a funnel for you to take W-2 income and then transfer it to be a funnel. That may be a problem. But it is okay to have a loss-making business and you're paying your kids, as long as they did the work and the business is not considered a hobby. Because at times we have a hobby. Remember, the IRS says that if you're making losses out of 3 of every 5 years, it's going to be considered, it could be termed a hobby. That's what the IRS says. So basically, make sure that it's a business that's not a hobby. You have, if you're starting a business and your children are working in that business to make it work for you, you have to pay them. That's okay. It's okay. As long as you meet the code section 162A, you're making them do reasonable work. You're making them do work that is ordinary and necessary for that particular business that you're doing. Then you are in good stance. Yes, you can do that.
Okay, that makes sense. Thank you.
Perfect. Any other question?
Question.
I'll take 2 more questions.
Hey, this is Val. Sorry, I can't be on video because I'm currently in a very awkward environment. But thank you for your great presentation, Njoya. So my question is this: talk about paying your kids, not necessarily putting them on a payroll. So I just got a signal there that what if you already put your kids on a payroll, and your payroll was designed in such a way that, those taxes, like you were showing, those taxes are not, triggered. But I mean, they're actually on a payroll. Like you run payroll for. So how is that going? Is that going to be a problem? Yes, you still respect the standard deduction that you don't go above it, but they were actually on payroll. Is there any problem?
Again, it depends on the structure of your business. Remember when I started, I read what the IRS says. The IRS says that if your kid your business is structured as a corporation, an S Corp, a C Corp, an estate or it's a sole proprietorship, then you would have to pay taxes. You have to pay those taxes. So basically, that's why I said, first of all, you have to make sure that you have the proper structure for the business. If you have the proper structure, I want to read that paragraph to you. It says that payments for the child services are subject to income tax withholding, regardless of age. That is the baseline. However, if the child is under 18 and working for a parent in a trade or business, payments are generally not subject to Social Security and Medicare. And if the child is under the age of 21, these payments are not subject to FUTA. Great. However, that is where it comes in. If the business is structured as a corporation, an estate, or a partnership where only one of the parents is a partner, then you must withhold all those taxes. You want to make sure that you meet that. If you meet those requirements on there, and then you're passing it through payroll, the reason we talk about family management company is because we are trying to avert that one. If you have those things and you're passing it through payroll, you're not withholding all of this, that may be okay. That may be okay. Does that make sense? Did I answer your question?
Yes, I got to. When you talk about corporation, S corp, and all that, what is an LLC, right? I don't think that is S corp. It could still be like a sole proprietorship. I mean, I just want to get it clear.
So the three entities that we talked about here was corporation, estate, and partnership. Okay, and that partnership where only one parent is a partner. That's a problem. Okay. Now, when you talk about an LLC is a state type of structure. The IRS knows that there is something called LLC, but they don't, in their system, there is nothing called LLC. An LLC has to be an election. If you are a single member LLC, the IRS defaults you to what you call a sole proprietorship.
Right.
You are defaulted. But now, if you have multiple partners, it defaults you to a partnership. It becomes a partnership automatically. Now, you have the election, the ability to go and elect it to be something else. You have that ability. So when you talk about LLC, LLC itself doesn't mean a thing until you have to look at how it is structured. Is it a single member LLC, in which case it defaults to a sole proprietorship? Or is it a multi-member LLC, in which case it becomes a partnership? Unless you have now elected to be taxed otherwise by the IRS. The IRS only deals with it, only looks at it from those perspectives.
I think you answered my question. I think you answered it. That point of that election, I think you answered it. Thank you so much.
I appreciate that. Thank you so much. Yeah, any other questions? Let me look at the chat. Any question in the chat? Yeah, so basically, I mean, I just want to thank you. What time do we have here? It's almost 5 o'clock. Guys, I just want to thank you for taking the time to be here today. One other thing, somebody says, can you pay your parents to babysit your kids while you work? How can one report that? Okay, you can basically, yes, you can pay your parents to babysit while you work. That's for sure. Again, babysitting, when a parent is babysitting, is called household employee. Now that person is a household employee. That's a completely different ballgame. So basically, it's a household employee, and that's completely different from what we're talking about here. And that one we can talk about it in another session. Yes, but you have to pay them. You can pay your parents while you work for them to babysit you while you work. But if you are doing a W-2, then you may, I mean, there's a way to do that, but we can talk about that as well. When these things are very easy, they get very easy when you own a business. That's why businesses are always looked as the way to make most of these things happen. And I tell people all the time, whether you are doing what, whether you're making $2 million from your job, always have a side gig, because that allows me as a tax strategist to be able to do anything I want. We can do a lot of things if you have a side gig, if you have a business. If you don't have a business, it becomes very difficult to do certain things. Thank you guys very much. Today, I just want to tell you, I am going to be speaking extensively on Tori Day. There is at 6 p.m. I'm going to be on Tori Day. It's on Facebook, it's live. There are going to be hundreds of people on there. And if you want to listen to more of these things, first join us until we day tonight at 6 p.m. Thank you so much. I appreciate you all.
Thank you, Charles.
Please go like our page, follow us on YouTube, Instagram, Facebook, and then we are doing these things more. We have a lot of these presentations on our pages. You'll see a lot of these presentations that we've already done. Thank you and have an excellent rest of your day. Bye-bye. Can I have a jingle, please?
Thank you.
Thank you. I appreciate you guys. Can I have music,
Thank you, Mr. Charles.
Thank you. Thank you.
Thank you, sir. Thank you.
Next appointment next
Thank you.
week, same time. Next week, same time. It's going to be very, very interesting next week.
Okay, thank you.
Thank you. Bye-bye.
Thank you. Noted.
Can I have a jingle? Can I have my music, please? Please, please. Okay.